just as a quick note, my previous microphone has gave up the ghost. So we're using a backup mic, and I do not like this microphone. So until I get my new one from Amazon, which I'll order when I'm done doing this recording, we'll probably be stuck with this. Okay, so I apologize if it isn't as good, or if it's different, if it's something different about the audio that you don't like. Just know that it's a different mic, and I have no choice. So here we are with the dollar index daily chart, and I'm going to try to go through this rather briefly because this is a lecture that I could spend hours on, extreme amount of time, and I want to make sure that I don't do that because I don't want the video to be too long, because that makes my job harder to render all the versions I have to do for each user group. Also, I don't want to inundate you with things that, especially the new group, aren't going to know that much about, but I want to demonstrate the level of precision that you're learning here. Some of you charter members will be learning something also today as it relates to precision-oriented things that you normally would see with model number 5 as a charter member. So just know that we're going to be working with some things here that are not meant for the public. And I know some of you are already in here selling copies and editions of your videos because I'm actively buying them, and you don't realize it, but I am. And I'm weeding you out. These are the types of lessons that I would have done a whole lot sooner, and much more deeper than this, because it does get way deeper than this. But because of all the leaks, because of all the really just lack of character and a money grab for the people in here that aren't going to really try to put the work into learning this, because my stuff's in demand, everyone wants it, and they know I'm not taking another mentorship group in, that creates this whole demand. Okay, and I understand things are hard right now in the world, and maybe you're hurting for money. Maybe you lost your job, or you just realize that you could probably make money selling these. The reason why I'm doing a lifetime membership community is because once the door has closed, like it has, I will eventually get everyone. And as they come up with new people wanting to sell things or share, I'm making it available for other people to come in here for free when they rat you out. And I have, at the time of this recording, I've done 112 people. That's how many people have been removed from this mentorship since January of this year. So that's just the ones that I'm aware of. And I have a few of them I'm still working on that are in here leaking and selling. So just know that your user groups are going to split again 2 times this week. It's going to split after tonight's video because I know that this video is going to get shared, it's going to get sold, it's going to get pushed around. I also know that within the next 2 weeks, I'm probably going to have 9 more people out of here because you don't listen and you don't respect the ground rules. I just want you to be reminded that I haven't stopped. And just because you don't think you see a watermark, the lack of a watermark is a watermark. All right, so here's the daily chart on the dollar index. As you can see, FOMC today, cent price outside of the fair value gap, even above this old high, even through our fair value gap, and all the way back over to the volume imbalances where we're most likely going to be reaching to. So we got all the way into potentially a run into this buy side liquidity. So if we go above this, our focus goes over to here. Okay, so that's why these lines are here. So when we drop down to the hourly chart and 15-minute time frames, those levels are what you're seeing relative to the volume imbalance on the daily chart. Notice that we did on Thursday drop down outside of the fair value gap momentarily, just to go into consequent encroachment of the fair value gap between this candle's high, this candle's low. Consequent encroachment back inside the range of the fair value gap while it's being held in consolidation waiting for FOMC. Then they repriced it higher. Now, why is it having such a huge run up? Is it specifically what they're saying? Well, I don't personally go into the FOMC statements because the banks are going to do what the banks are going to do. And it doesn't make a difference one way or the other. The only verbiage that was really used in this one today that I had to take a look at just to make sure that I included it here for completeness sake, but I don't go over them for the sake of trying to decipher it because it's already in the marketplace. You can't look at that report as soon as it comes out and start doing calculations and stuff. It doesn't work that way. Okay, and years ago there was all kinds of scammers running these services where they would create green or red. If you want to be a buyer during a news release, it would be a green button. It would flash up on your indicator, and then or if you want to be a short, it would pop up red. And what they were trying to do was decipher what the news was basically saying. The fact that you cannot even get in the marketplace right when the news event occurs at a good level because you're going to get requoted to death or your limit order won't be respected. These moves are so quick and sudden. To think that you are going to get in them right when the report comes out is nonsense. That's why you have to be in the move ahead of time, and hopefully you've made money on Monday, Tuesday, or Wednesday, and you have a small little piece left on. Now, some of you are checking out the YouTube channel commentary, and you're also looking at the Telegram. And I'm going to preface it by saying that if you go into the Telegram, just know that you're probably going to see things that's going to frustrate you as a mentorship student because I'm not going to go into great detail there, and I'm actually going against what I'm teaching here in mentorship. Now, let me briefly state what I'm doing here. I've had people freak out and get offended that I was teaching anything outside of mentorship, and they were all up in arms saying, well, I'm going to quit if you're going to be teaching for free. Well, this kind of lesson tonight and what I've been doing all year is nowhere near the level of anything I'm going to do on YouTube, let alone a Telegram room, okay? But I love teaching, and I have a lot of folks that reach out to me that can't afford to be where you are right now. So to do what I feel my purpose in life is to teach, I make my time available, even though it may feel like I'm spending a whole lot of time there. I'm not. But the idea is I'm teaching them things that are learned from the YouTube channel content. And I specifically used things that I teach on that YouTube channel to do the trades that I do and make examples of with executions, management, and everything that's being done there. That is all YouTube based. None of that has anything to do with what you're learning here in mentorship, period. The idea of learning from Telegram, if you are a mentorship student, is probably not good because you're going to see things with better clarity here, and you're going to be asking me questions in email that are really not germane to what you're learning here in mentorship. Now, you're probably thinking, well, you're really doing a disservice to those people in the Telegram. No, I'm not, because what I'm teaching there works. It's not going to be as precise. I'm not going to teach narrative. I'm not going to teach the precision like I'm going to teach here tonight. Those things, because they've been passed around, okay, these lessons, videos, and such, they get pushed around. People share them, sell them, whatever. Or they're trying to do YouTube videos and channels trying to get ad revenue to make money that way as a side hustle, talking about hindsight moves because they don't know how to do what I'm going to show you tonight. Which I'm making another reminder here. These are the types of lessons that when I see them shared really make me gear down and not want to go deep into the things that I would love to talk and teach in this community. But greed and lack of character and couth by few. Now, you might think 100 and some just for this year is a lot. That's nothing compared to our community. But I'm sure there's probably a larger scale going on because there's lots of different countries in here being represented by the members, and they're probably doing it low key. But low key, on a grand scale. And I can tell you already, I've made millionaires, okay, from people selling my coursework over the years. not just in this mentorship, but people have gotten rich taking my content and just blowing it up and just pushing it and pushing it and pushing it. It's going to be hard for me to make them not want to do it because of respect or just general principle, because they're making money. But ultimately, those types of people have caused me to dial back how much I wanted to teach. Now, I know some of you are going to get all up in arms with this, what I just said, and I've said this in other instances over the last 2-3 years, when piracy has been rampant in this community. I mentioned several times that there's things that I'm just not going to teach now. But you continuously keep learning new things. Tonight's lesson is one of those lessons that if you understand this, with all the things that I teach in this, just the core content, you are going to be able to do things that nobody else can do. It's going to look superhuman. It's going to look ridiculous in the eyes of other people. And I want you to understand this. If you go in and start trading with your live account trying to get this precise, you're going to get banned. Period. You're going to be removed by the broker. And once that starts, you're going to have the burden of having to trade through a relative or a friend. And do you trust your relatives with lots of money if you want to run the account up? Do you trust your friend if you're going to be trading in their name? These are problems that you're going to create for yourself if you try to be Mr. or Mrs. Perfect. They're going to see what you're doing. It's just completely on a different level. And trust me, from experience, they don't tolerate it. Okay? So just know that I've warned you ahead of time. I've explained that these types of things, if you do them in live accounts all the time, trying to be as precise as I'm teaching you, you will not be allowed to participate. Period. So, with that said, let's roll on into the hourly chart. All right, so here is the hourly dollar index, and you can see that we maintain that consolidation in here. And we'll come back to this when it's time to talk about that British pound homework. But we consolidated in here, and then right in this low, we created an optimal trade entry right after midnight. So we have the low, high, optimal trade entry, a smaller one right in here as it returns back in the order block as well. And then obviously FOMC sends it higher. Watch your volume imbalance on the daily chart. That's this right here. On the 15-minute time frame, nothing really to speak of in terms of distinctions between what we've already just mentioned on the hourly chart in here, because it's been held in consolidation ahead of FOMC. Notice the repricing here. Aggressive repricing. If you try to buy into that, you're not going to get filled. You're going to get requote, and by then it's up here. And who wants to be in it at that point? Because then you have all this behind you. And now, as we see price reaching up like this, can it draw back and correct before going into the daily volume imbalance? I don't think it needs to. I think that it's running aggressively on the funds that are short dollar. And that's why they're doing it aggressively, because they don't want those large funds to withdraw their liquidity or their orders that would otherwise be ran out. All right, here's the euro dollar daily chart. And originally, earlier in the week and the weekend, we had these lines here for the fair value gap there. We've completely cascaded through that. So now I'm drawing your attention to here, because this is where we might be drawing to on a more intermediate term basis. Notice that we worked inside of this fair value gap in here. I said if we work back up inside here and act as resistance, in other words, it returns back in and acts as a barrier, if you will. Notice the bodies of the candles here. See where they're respecting? The premium high of that fair value gap right there. That's not random. Yes, we have all this price action here, which is the mirror image of that discount fair value gap on the dollar index. But on the euro dollar here, we have a fair value gap high and low, so the discount low, premium high, extending out in time, it trades up into that. See that? That was Thursday. And then we return and close right back down inside that fair value gap right here. And then the volume today was predominantly ahead of FOMC, was inside of that fair value gap. Even though we had a little bit of a wick higher, we have a swing high and then aggressive repricing lower. And it completely smashed through this fair value gap. Now, does that indicate bullishness? Not when it comes through this low, all the way through this, and we're potentially, basically going below this low here. So if we go below here, I don't trust this as an order block. I'm thinking this is where they're going to reach for because it's more obvious. We have the imbalance as well, and then we have sell-side liquidity pool. So this is, in my opinion, a more likely discount array that it's going to pull to. Does it go straight on into it? I don't know. It might need to consolidate, 1-2 days before it does it, and then send it lower. We'll have to see. But ultimately, I think the dollar is going to want to run up into its daily volume imbalance, and that's going to set the pace for what euro does. Euro hourly chart. Here is the 1 hour chart here, and old low runs up into that fair value gap there, comes back down into the daily fair value gap, bounces around in here, trades one more time up into the bearish order block, optimal trade entry, which is a mirror image of what we saw on the dollar index, bullish optimal trade entry, prior to its run up ahead of FOMC. Then we see the opposite shown here. So again, keep your charts noted here and your focus down here, because as we trade into next week, we'll probably be inside of this range here. And then the 15-minute time frame for euro dollar, nothing doing in terms of any contrast from what we saw on the hourly chart. So this consolidation, optimal trade entry, respecting the premium high of the fair value gap, and then sudden repricing. So again, unless you're positioned ahead of FOMC and holding some kind of a piece and you're on side, you're not going to get these moves. Okay, that's just the way it is. British pound daily chart. Beautiful delivery down into the fair value gap here. Now I mentioned that if we took out that Friday's low here, as we did, that we would most likely reach down into this here. And initially on Sunday I was giving you an honest review of what I was looking at in price, because it was ahead of FOMC. I didn't know how we were going to open up on Sunday, and that's always a wild card. But the idea of breaking Friday's low and then sending us down here, that was likely to occur with FOMC. And you can actually hear me talk about that when we spoke on British pound versus US dollar. Now, I'm not trying to say, ha ha ha, look how smart I am. Okay, so make sure you hear me clearly. The bias, I wanted to see dollar go higher. But if it was unwilling to make its move above its fair value gap on its daily chart, that was indicative of what? It's going to be held in consolidation, and I wanted to see it break lower. Well, it went down just to fill a fair value gap on its daily chart, and then dollar went back into its fair value gap, and then day of FOMC, which is today, Wednesday, it takes off and goes vertical and runs to not only the premium arrays that I called out, but well beyond it. So if we're looking at that in terms of the opposite for cable here, the narrative was focus down here if dollar does go higher. If I was wrong about what I wanted to see in dollar, he just admitted it. Yes, I'm going to get it wrong sometimes, but I want you to see what I executed with this week. I did a one shot, one kill, even going against this analysis. This is where I want to make sure that you understand that I'm not teaching this in Telegram. I'm not teaching it on YouTube. I'm able to go both sides of the marketplace. You saw that in my cable trade. That exit was predominantly linked to this bearish order block right there. Remember the narrative I mentioned before? If we break this and we did it here, it's likely to go down here. So on Thursday, we went down here, and then we opened and traded up into that level. That's all I was working with. I was working with that level in here up to here. I was buying basically a rejection block deep inside of this old buy-side imbalance. And then I wanted to get back up into that bearish order block. And then that was it. I took the majority of the trade off, and I had a small little piece on there. If I was right about dollar going lower and resuming its long-term downtrend, because I'm trying to teach you not to trade and pick bottoms in bear markets or tops in bull markets, because you can hurt yourself. But you still can make money doing trades with that, even if it does break down like it did here. And I use the rules that I teach you, which I actually taught in free content too, because I don't want anyone to get hurt. So the same rules I teach relative to non-farm payroll weeks or FOMC is you want to make your money early in the week and then leave a small piece on and then let that be your lead in the water if it wants to take off and be a runner. If you're wrong, who cares? It takes a small little piece of the open profit you have, but you've taken a lion's portion of the move off ahead of FOMC. So I'm longing the market here and getting out as it runs into that bearish order block. So as it's breaking lower, I don't want to have any lessons or any discussions about this. Okay? Notice that? I didn't talk about anything breaking down, but I gave them from a free mentorship level, not in here, but from a YouTube perspective or Telegram perspective, and you got to watch me execute again. But the point is, they're not being drawn into these lessons or this area down here at all in anything that I'm doing. Nothing. It's not happening. So I can still teach and use free content, and none of you should be upset about that. It honestly upsets me that you are so possessive of me, and it makes teaching not as fun for me as it would be if y'all just relaxed and just let me give it to you as I give it to you. So this was the overall framework here for the breakdown, but I want to give you the details about this right here as the teaching, but we got to go through the final stages of the breakdown here for cable. So in the hourly chart, you can go back and, again, I sent a comment to the community tab on my YouTube channel stating that you should go back and watch Sunday's video. Sunday's video, I mentioned how if I was wrong about dollar and it does want to go higher, that this fair value gap here, it want to run up into that level there, and that would probably be the catalyst for sending it down into the daily fair value gap. Don't take my word for it. Some of you probably didn't even watch the video. It's not that long of a video. You can actually scrub through, get to British pound area, and you'll hear me talk about that level right there, trading into that low of the fair value gap. That could be the turning point. If I'm wrong about dollar being bearish, if it's going to be bullish, this is what's going to happen. It's going to go to that level there, the low, and then send it down to the daily fair value gap. Well, look what happened today. Here's the fair value gap being tagged to. Here's the low. Did it trade to midpoint? Consequent encroachment? No. Did it close it in? No. Now, your question is going to be, how did I know that? How did I know it wasn't going to fill this fair value gap? Because if I'm wrong, remember what the procedure was? If it was bullish for cable and bearish for dollar, it should go through this ahead of FOMC and then come back down in and find some support. That, I would like to see that fill. But if I'm wrong, I want to see this act as a breakaway gap. Notice this? The logic is this becomes a common gap if it trades bullish ahead of FOMC, like I was mentioning in a commentary on Sunday. If it comes back down into it, that could set the stage for a rally to take out that 142 big figure on cable or British pound versus US dollar. But if I'm wrong, and this is a little bit of algorithmic theory that you shouldn't be getting as a core content student, but I'm trying to teach you, there's a distinction from what I do on YouTube and in Telegram versus here. This is master level, okay? It's not even college level. It's master level. So when I'm telling you things in advance in these commentaries, I'm actually going through the process of what I know that the algorithm is likely to do. Once it happens, then I have the luxury of going back in and telling you like I'm telling you here. Most of you in here want me to tell you in advance so that way you can trade it. I'm never going to do that. I'm never going to do that. And let me explain to you why I'm never going to do it. And you should all understand this. I don't care if you get mad. I don't care if it feels like it's unfair, because it was never promised to you. Okay, but I want you to know why I won't do it. If I do signals, if I outline the moves to a T beforehand, all these yahoos in here, and you know who you are, they're going to parrot what I say. And they're going to create channels, Discord rooms, Telegram channels, mentorships, and they're going to be able to sell the idea that they know exactly what they're doing, but they're only going to be parroting what I'm saying. I'm not going to enable folks like that. And yes, it's unfortunate that some of you in here that would do that messes it all up for everyone else. That's also the reason why I promised, even in the description of the mentorship, that it is not a signal service. It's never going to be a signal service. I'm never going to tell you beforehand where the entry is, where the stop loss is, where the target is. I'm never going to do that. Now, there was a time that I wanted to do that. Like, I wanted to do those things. But because those individuals in here and those that have been thrown out already, they're the reason why it won't happen. Because it would be completely abused, way beyond just the videos themselves. Because that's what everybody wants. They want to hear me tell them what's going to happen next in the marketplace. And the better students in here can more or less get to what I'm saying, like this example here. I'm telling you without walking you to the signal. I'm not leading you there at the time it occurs. I'm not telling you where your stop needs to be. I'm not telling you how to trade it, how to manage your stop, and where to take partials or take the exit. I'm not doing any of those things. That's the part of you learning, and you'll find your own way of doing that. And there'll be different ways of doing it. They won't be exactly the same, but you'll be doing predominantly the same things. But all of your results will be different. That's why I say, when people ask me, what's the average that your students have as a return? It's all different, because some of you will just take this trade here and not have the willingness to hold down to that low. And you'll get out just at this low or just above it because you think it might be protected or defended and not go below that low. Or you'll go below that by 10, 20, 30 pips. Others would see that if it's going to go down to that level there or lower, that means we're crossing the 140, and the rules are if we cross a big figure, it can go as much as 40 pips. So that sends us down into 139.60. So that's below consequent encroachment. That makes sense. So they would take their exit below this low or fair value gap premium high on the daily chart. They would take it just at the consequent encroachment level and allow for it to be trading just below consequent encroachment, but their limit order would get them out, basically midpoint of this range. So all of you are going to decide what it is that you're going to be doing with this information. And none of it's wrong. There's not an improper way of doing it. It just means that you're going to find your own niche in this that makes sense for you. And that's important, because you have to have a model that makes sense, that you're comfortable with. And even with these rules being slightly differently used from student to student, but the overall context is the same. We're looking for these types of displacements and movements lower. If certain things happen, then how you trade them and engage them is going to be different from everyone else in the mentorship and from me. But your positive result is going to be meaningful to you, because it'll make sense why you got out there, and you'll be able to sleep at night while you did it. You won't have to worry about, hopefully this is the path that you should be following, is that even though moves will go many times beyond what you expect them to do, you're not worried about that because you're finding consistency in the way you're doing it. And an example of that would be if you were selling up here at the order block, which is what this red line is. Here's that daily bearish order block. It's trading up into it, but it's hitting the fair value gap level there that I called out in the Sunday video. So I said, if it's bearish and I'm wrong, it's going to likely go up into that level there, hit the low, which it does here, and then send it down to the daily fair value gap. Okay. Now, if this was the Friday's close, that was the weekly range outlined beforehand. But in this case, it's Wednesday, so we have more days still. So what does it really work out to be? Potentially what? The daily high and low on FOMC. Now, FOMC is a random market event in everybody's eyes. It's not random in the sense that I don't know all the time what direction it's going to be. Okay, I don't know that all the time. I can't consistently sit in front of FOMC and know beyond a shadow of a doubt this is what's going to happen. But clearly you can see in Sunday's commentary, I had an inkling if I'm wrong, it's going to go down, it's going to do it like this, and it did. But I would have preferred for dollar to go lower, so that way I could go long cable and run it into 142 big figure, maybe 142.30. That's what I really wanted to see happen. But if I'm wrong, I'll know why I'm wrong. And if there's something to do on the opposite side or how I would view it, I'm going to share that with you. I admitted openly on Sunday that it's going to sound like plan A, plan B. But I needed to know what it was going to do technically from Sunday's opening and how we worked price. And then as we went into non-farm payroll, you saw on Tuesday I was trading long cable or British pound up into that bearish order block. So I'm exiting right in here. Even though I had a level outline saying I wanted to see it go above the previous highs, I don't want to draw attention to these types of events here. Like, I don't want to do that. Believe me, I wanted so badly to get out there and go short and just ride this thing down through FOMC. I really wanted to do that. But I was like, no. Let me just get out right here, and that way it'll make sense to you all why I'm doing it. And the pattern I'm giving you right now in explaining why I was doing what I was doing should make pretty good sense to you as a student here, because you know things that they're not aware of and what levels I called in advance, and you can see obviously the result of it. Now, did I go short? Did I trade this? No. I don't need to trade it. You knew about it on Sunday. The details are here. Did it deliver as I outlined if it was bearish? Yes. Do you need me to be in a live trade for you to learn from this example? No. Do you need me to be in a paper trade to learn from this example? No. The logic and processes is what you're here for. Learning this is why you're here. So keep that focus. I can do these things, but it's not necessary for me to do these things for you to learn. Okay, that's kind of like what I'm getting at. Because we're going to slowly be working into teaching so much that I'm not going to be spending that much time on future moves or analysis. And some of you are going to be belly aching me. Hey, can you talk about what's likely to happen in this market? Or can you talk about this and can you talk about that? I need to get through the teachings. Okay, and then once we get through that, then our community can be about all that stuff, because my time will be freed up and I can talk a little bit more about those things in the forum, and I don't need to do videos to do it. All right, 15-minute time frame. Remember, this was supposed to be a brief video, right? Every time I say it, it always makes it a longer video. So we can see here on FOMC Wednesday, I went long in here, right here on this candle. And you can see that on the video in my Telegram channel. And what I was doing was, just so you guys know right away, I was watching the dollar index on the right-hand side of the chart, because I had the chart split. I had cable on the left and dollar on the right, and I was watching dollar run up into its old high as this was trading down. I wanted to buy it right when it hit this candle's low, because you understand what that is. That's institutional order flow entry drill. But I realized that I was going to be sharing this with Telegram, so I had to wait. And I purposely waited for it to come off that low there. Once it come back up a little bit, then I bought it. Because why? I'm not trying to teach institutional order flow entry drill. Now, is it commonly referred to by people that have seen leaked videos? Yes, but by itself, it's like an order block. Everybody thinks a down closed candle is a bullish order block. It's not. You have to be trained by me. You have to understand narrative. There's a lot of things that have to be around an order block for it to be a real order block. And it's not the candle itself, it's the change in the state of delivery. That's what's occurring there. And that's what's not been taught on YouTube. And that will not be taught on YouTube. So anyway, I went long on this candle here, and I bailed right in here. But it was based on this bearish order block from the daily chart. You all know in the video, and you can see it, and you know the logic of running out this old high. Even though I had it in the chart, I didn't execute there. And I waited for this thing to pop through. While I was in the Telegram chatting this morning, it ran through that, and I was wanting so badly to get short. I was like, no, let me just let it go. But you know all the things I'm teaching you here. You understand if it hit that level, it's going to go down there and deliver on FOMC. And here we have it. All right, so on Tuesday, I uploaded a chart to everyone's area in the forum. And I got to tell you, it's really nice to be able to do that. It saves me a lot of time. It allows me to post it in all the forum user groups and gives me a chance to give you homework and then give you some work to do instead of just sitting and watching a video. You go in your own charts and dig around. So that's going to be kind of like a lot of things we do going forward. And then I'll teach a little bit more in the midweek and teach, obviously, more things on the weekend commentary. But this is how you learn. This is how you get through the content and really absorb it. So I wanted to cover this move here and talk about how this chart was created. And in my haste in making it, I freehanded moving all these lines around. But I'm going to actually walk you through the process that we can see that this level actually isn't accurate, because I'm going to teach you how it goes right to the low of that candle. Okay, but because I was visually looking at it, I thought I had it, and I just drug it down, and it didn't. It didn't match up. It says here 3, 4, and 6 pipettes, when it's 3, 4, and 4 pipettes is the low there. Okay, trust me, when you walk through this process, you're going to see that actual low with this. Okay, I'm going to show you how to do it. That way you know exactly what the daily low is. Now, that same level here is that daily bearish order block. So the premise is what? It's consolidating, and then it rallies up. Okay, so what we're seeing here is this is the Asian range, and we're taking the Asian range from the bodies, high and low, and we're using the highest high in the bodies, not the wicks. Okay, that's what I'm focusing on, just the bodies here. Okay, so I'm identifying the highest body and the lowest body here. And then what I did was I split that range in half and draw it through here. Now, right away, does that sound like Chris Laurie's approach to using the Asian range? Clearly not. Okay, he has no idea what this is about. Wouldn't even know what to do with it. And honestly, sometimes I wish I never would have taught it. If I'm being completely honest with you, I wish I never would have taught this. I wish I never would have even mentioned I even knew it, because I know this lesson is going to be abused. I know it's going to be abused, and I know I shouldn't be teaching it because I know it's going to be spread everywhere. But just be reminded, this is the reason why I have said I'm only going to go so far. Okay, and when we're done this year, that's it. But even if you just apply this, this is superhuman level precision. There isn't a man or a woman on the planet that ever would have known about this had I not mentioned it. Okay, so I want you to know that. I counsel, okay, I educate people that you're never going to have seen on a YouTube channel, okay? You're not going to have mentorship groups, okay? They're not going to have academies, okay? These people are in fields that they're not supposed to be seen. They're not supposed to be referred to, okay? So that way we know who and what I'm talking about here. It's the they. This approach here is scientific. The guys from Goldman Sachs will laugh and say, it's not technical science, when it really is. Because they believe in supply and demand, buying and selling pressure, when that's not what goes on. And I want to remind you of that, okay? The idea that Goldman Sachs, UBS traders, Citi traders, all these folks out there, you think that they're the smart money. They're not. They're just the well-funded and well-financed traders, which have impeccable risk management protocols. That's why they are profitable. It's not because they know these things. Trust me when I tell you that. They don't know these things. Period. The interbank level traders, they use things even more precise than this. Okay? I know things that I'm never going to divulge to you because I'm not permitted to. So what I had to do was I had to break down the things that I know about what the algorithm does and what it doesn't do, and find ways to be able to communicate that as close as I possibly can without breaking the NDA. Okay? So some of you may be questioning, well, aren't you one of those sleaze bags that you complain about that's leaking your content? No. No. Because what I'm giving you is a different approach that gets you close to a result that is otherwise unknown to everyone else. I'm giving you a science to a result that will give you enough of this type of event. If you look for it once a week and you get it, stop. Don't do any more. Especially if you're trading with live funds, because all you're going to do is put a spotlight on you. And they're going to ban you, and you won't be allowed to trade. Does that mean they keep your money? No. But they're going to close you out, and you won't be doing business anymore. And you try that with another broker, and the same thing happens there. Boom. Now word spreads, you can't get an account opened up with anyone. So it pays to have friends that you really trust and family members that you can trust. And that's the reason why I'm not as vocal about brokerage firms. Not only for compliance reasons, because I'm not an introducing broker. I'm never going to act as that. But I don't want them looking for me more than they already have. Okay? So just know that there's always a way around it. If you find yourself, banned by a broker, there's ways to do it. Like you can get a friend and start a partnership. Okay? And the way you do it is he opens or she opens the account up, and you draw up a limited partnership on paper that your partnership with this person, and the profits will be split, whatever rate of return you guys agree to. That's the way it is. Now, obviously, you run the risk of someone seeing how much money you're running it up, and they think that this is probably a fluke lottery win, and going to continue. And they say, well, this is really technically my money, and they skip town. And that has happened, but when they quickly find out that that money stops, that's the incentive, that you want to make sure that that partner of yours, whether it be a family member or a friend, I would prefer it not to be a family member, because family members are notorious for saying, well, it's really my money. Friends tend to have a deeper rooted relationship if you have a strong friendship. And if you can build that friendship even stronger by having their net worth increase with your partnership with them, you can beat all of the broker bans. Okay, and there ain't nothing anybody can do. They can't prove it unless you say, yeah, I'm giving that guy the insight about trading the market, and they're just taking the trades. There's nothing anybody can do about it. Okay, so there's always a way around those types of things. But just know, if you start using this in live trading and you start beating the brakes off of the market, do not try to be a phenom. The only thing you're going to do is make your life harder in this industry. The worst thing you could do is be that crackerjack, that ace, that Mr. Perfect, okay, that Miss Thing that does everything right. You have to lose sometimes, folks. You have to throw it sometimes. You have to do things that don't make any sense. You got to go in there and buy when you really should have been selling, and let the move run against your supposed mistake. That really throws off brokers that are watching you, because then when you have these fluke runs where it pops off and boom, 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 you get these huge, big runs, go in there and try to draw your account down by 7% or so. Not in one clip, but do it. And it doesn't make sense hearing that, okay? Especially the new folks in here. They're like, what? I would never do. Well, if you start having this level of precision, stick around long enough and they will be showing you the door. They're going to make it hard for you. They'll start doing requotes. You won't get your fills. Believe me, I know this, okay? That's how they do it. But as soon as you start playing the, well, he gets lucky once in a while, or she gets lucky once in a while, but she throws it more times. When the nice moves come, throw them. There's a lot of easy bread and butter setups that you can make all month long making money. And if you show that track record to somebody else, it's still profitable. But you are here wanting to have 90% ICT level precision with the highest high and the lowest low. And I'm telling you, they're not going to let you do that and not stay in the game. It's not going to happen like that. So it's a give and take. You take when it's the best for you, but when it's good and it's something you can just live without, let it go. Trade against that position, put a small loss in, let it take your stop out, and then go about your business. It doesn't feel fun. It doesn't feel like that's the thing you should be doing. It's not why you got into this business. But that's how you stay in the business at a large level. And not one brokerage firm and one account. If you can, try to have another account open, because if you see them working against you, and they will do this, and there's nothing you can do about it, folks. They're going to blame it on liquidity. They're going to blame it on whatever. You'll know that they are watching you when you start getting requoted like crazy when you're buying in a down candle and it's requoting. They know what you're doing, and they're watching you, and they are trying to mess you up enough where you don't get that fill, or you do what? I'm changing brokers. This broker's, not working with me. So guess what? You did them a favor. You're getting out of their brokerage firm. And now some of you are going to say, well, you make it sound like the broker, wants you to lose. No, the broker doesn't care if you lose. But they don't want to be on the opposite end, because if they can't pair you up with a trader in their own pool of liquidity, because there's a lot of brokers that act like that. They're not always piping you out there into the interbank where you can find another counterparty. Many times you're working with their in-house liquidity pool. And if they can't find a counterparty to you, they take that other side of that trade. Do they want to be constantly losing to you? No. Think about it. That's the stuff that nobody knows about. They don't hear about, and that's what goes on. It's not fun. It's not glamorous. It doesn't make you want to be a trader. If you start hearing about it right from Jump Street, when you're starting to learn how to trade, you hear these types of things. You're like, man, I'm not doing this. Yeah, if you're a retail trader and you don't know what you're doing, then yeah, it's easy to talk yourself out of this industry. But when you see the things I'm going to show you tonight, it just makes it more incentivized to say, okay, I'll deal with the crap once in a while, because it pays to deal with the crap once in a while. There's going to be some adversities. There's going to be things that don't work out for you. But trust me, it's well worth it. So we have the Asian range defined here with the lowest body and the highest body. And I just accented it with thick lines here to draw that that's the range we're working with. And I split the range in half using a fib, drawing it from the highest body to the lowest body. And by doing that, I give the exact 50% level on the fib. Once I know that value, which is here, 1.41076, okay, that's what I'm using. If you do this on your own chart using Forex.com's feed on the 15th of June, okay, or actually it's technically the 14th because we're in the data for the 14th. If you do that here on a 5-minute chart, it's important it's 5 minutes only, not 15, 5 minutes. Why 5 minutes, Michael? Because that's what the algorithm will use. Okay? I can't go into any more detail than that. I know you want me to, but trust me, it's all you need to know. If you're doing what I'm teaching you here, it's always on a 5-minute chart. Trust me when I tell you, that's all you need to know. You get mad, send me emails. Can I know? No. This is all you need to know. So 5-minute chart, Asian range. You're going to take this, split it in half, find that range level. Then you're going to go into the trend Fibonacci tool. Okay, and I'll show you what that is in a minute. But I want to go over the details here, which set up this whole thing. That was part of the homework. Notice how we ran up into this run into the bearish order block level in the daily chart after it took out sell side liquidity here. So we had a drop down, it ran out sell side, and then ran into the bearish order block. Then created optimal trade entry, and then displacement, New York session, sell off, institutional order flow, drops. Hits this level here. And again, this is an error because I just drug it down by hand. The whole process I'm teaching you will give you the actual low at 143.44. Nails that low. But let's go over to the dollar chart. Here's the 15-minute time frame I told you to study. And on the 14th, you can see that we went up initially, taking out buy side liquidity, resting above these relative equal highs. Inside of that fair value gap, remember this is the daily chart's fair value gap. and this is the lower level fair value gap that it drops down into later on the 15th. So we have the initial run for buy side, which is when the pound dropped down and took its sell side here. Then it drops down and takes out this sell side liquidity. After it takes buy side, it hits this, drops down, attacks the sell side, which is going into consequent encroachment of what? The fair value gap on the daily chart, just below the fair value gap here. So it goes into consequent encroachment, takes the sell side liquidity here, then it pumps up into the buy side liquidity over here. Now, this is on the 15th. The 16th is today, Wednesday, 2021. That's FOMC. So is this likely to continue? No, because FOMC is the event. So what does it do? It goes back inside the range. Where? Consequent encroachment between the high and the low of the fair value gap. Right there. And then consolidates back inside the range. The dollar has to stay in consolidation, but cable is allowed to go lower. Now let's go back into the British pound chart and I'll show you how those precision elements are determined. Here is the bearish order block level. That won't stay on the chart, but as a mental note, just remember this is where it's at. You can see the body's respecting it over here. And that candle right there, if you look at that candle on your chart, okay, why that candle? It's the highest close or open with a beefy bodied candle. We don't like these little wimpy things here like that. We don't want that. We want a beefy candle, okay? That is the highest up close. That up close is what you draw your line across with, and make sure that the line's on there on that very level. For the low end, we're using this candle right here. It's the lowest down or open or close in a beefy body candle. You could use this one, but I won't. These are the rules. I need a beefy bodied candle, not these little wimpy type of candles here. Okay, if it looks like this compared to the ones around it, I'm going to go to the lowest one that has a bigger beefy bodied candle because there's more volume in that. There isn't that much volume in something like that. It's just marking time. That's what the candle's doing there. Here, there's more range in there, so it's going to excite more traders. It's not buying and selling volume or selling and buying pressure. It's volume. It's going to attract more attention. Do you get excited when you watch a big ranging candle? Of course you do. You may not be in the mood, but you're thinking, man, I wish I was in that. You quickly start looking at why it took place, didn't you? Everybody does it. So that's the rule-based idea why I want beefy candles, because it's going to draw more attention. That's why they create these candles. It's not because of the buying selling pressure. These candles are being engineered. So my eye goes to those. That's what the algorithm is doing. I can't teach you any more than that. That's as far as it goes in regards to that, but that's all you need to know. They're pretty simple rules, right? It's a 5-minute chart. It's a range between 1900 and midnight. So there's your Asian range. 5 hours. This whole business in between here, once we have that determine what the highest and lowest bodied candle is, and whether if it's a beefy candle or a little wimpy candle, if it's lower, like if I'm not mistaken, I think this is, I'm not sure what it is. But I know the low was 41,004, so it might have been like 41,002 or something like that. But because it was a small little candle, I elected to use this one. Okay, trust me, these rules do not move around; they're static. So now we have that range here. That's my Asian range. That's not Chris Laurie's Asian range. Okay, it's not anybody else's Asian range. It's mine. It's based on things that I'm mentioning here and in other places, but I'm not going to go into any more detail with it because to do so, it gets me in trouble. So I'm not trying to get in trouble, so be content with what I gave you. Trust me, the rules are simple. They're very, very specific and they're very simple. They're static rules. It's time-based, simple. Now, when you do this, you're going to do 2 measurements though. You will do it on the high wick and the low wick. You're going to have both numbers. You're going to have both numbers based on what I'm going to show you here. But once you have the middle point right there, you're going to take your trend-based fib extension tool, okay, and you can find that on TradingView. And the settings are like this, okay. Have all these on your trend-based fib extension tool. You can find it in the same area where you get your Fibonacci. And this is what mine looks like. And then when you do that, you're going to anchor it to the midpoint. You're going to drop it down, and well, drag it down rather. And this is where you see that where I made the mistake at, okay? Because I was showing you 41076, when in reality it's 41077, and you'll see this when you actually do the numbers between this candle and this candle. So this is actually calibrated correctly, and this is what caused that number to be off in the previous slides. But this is exactly what you're supposed to be doing. This is the rules, and you'll get the actual low, as you can see here, at 140, 3, 4, and 4. You'll see that that is the actual. So what you're doing is you're taking the trend-based Fibonacci tool and you're anchoring it to that 141077 level, which is the exact middle point if you lay your Fibonacci on this and this. So you're getting the midpoint or equilibrium price point inside of the Asian range. Once you do that, you're going to drag the trend-based Fibonacci tool down all the way past the low. And you're lining it up with that low closing price, which is 1.41004. And you keep dragging it down until it does that. And then once you let go of it, when you start moving your mouse back up, you'll get this second line. And you're going to match that up with the same level here at 1.41077. And you can calibrate it by simply doing the settings and making sure that the line parameters for, or the coordinates rather, is the high is 1.41077 for 2 of them, and the low will be 1.40930. And you're dragging it down. You don't know what this number is going to be until the midpoint 50 level shows a match of that range there. Now right away, stop and think for a second. Does this sound like something that you would have found in any other book or Fibonacci? Because it's not there. Okay, it's not there, folks. I want you to think about all of the possible scenarios that could have lent to me doing this discovery here. It's mind-boggling. But the reason why I'm doing it this way is because it gives you the splits, okay, or the 50 levels of this range here. That's why I'm anchoring it here. And I don't have 50 levels in this tool. Now, if you do 50 levels in the Fibonacci settings, like if you do like 2, then 2.5, and 3, and 3.5, then simply just add it to this level here, to here, and then draw the second one back up like it is on the 50 level. You would only need to do it on this point here and here. But because I know how to do this, I want you to know why I was doing the chart and showing the chart the way I did it. This is how I create it. And this is how I can get the midpoints between all of these standard deviations. Okay, so it's a midpoint standard deviation of this full range from high to low. Now, I know some of you new folks that just came in here at 2021 group, your head is spinning right now. You're like, what the hell is going on right now? Like, what is he doing? Like, it feels like trigonometry and calculus, doesn't it? Trust me, once you do this a few times and practice on old charts and things, you're going to flip out, okay? Because it's just beautiful. The main moves of the intra-week is when this is going to line up. You're not going to do this procedure and get every single daily high and low. Okay? I'm not teaching that here. I'm giving you an element to how far will it go down. And I'm going to explain more about this level in a minute, but let me just flesh this out here. So you're anchoring on the midpoint of the Asian range, dragging it down, keep dragging it down until the 50 level lines up, and this number will change and keep going down as you drag down. And once you get to a point where the 50 level shows the number that matches this low end or the Asian range, once you do that, let go of it and drop it. But it's still going to be attached to your mouse. And then when you drive it back up to this level here, this is why you see a line and another line. Once you do that, it gives you these projections. Okay? So it's the standard deviations of the Asian range with the midpoint, okay, or equilibrium price points between the standard deviations. So we have 5 standard deviations, okay. Now, it's not just simply looking for a line and say, well, I like that line, or I like that line. You're looking for a discount array. So you have to go back through data to find an array that matches with one of these. That's the secret. Okay, you have to be able to match it up with something that would make logical sense for the algorithm to reach down to. It's not just simply, oh, it went down to this one because, last time it went down there, my elbow itched, and therefore I'm going to use that every time. Now, if that's your model and that's what you want to do, go right ahead. But that's not logic. That's just, well, that's nonsense, let's be fair. But look at this right here. This is the 13th of May. Right here is the 15-minute time frame. See that? So that level of price action is what? Buy side imbalance, sell side inefficiency. The consequent encroachment is approximately in here. And look what's over here. 1, 2. Sell side liquidity pool. Imbalance. It can go down to a consequent encroachment, but the level is what? 140, 34, and 4. That's inside that buy side imbalance, sell side inefficiency. It could go to consequent encroachment, but this is the level that Asian range standard deviation is projected to for the 5th standard deviation. So now let's look at that scaled out. Right here is that same little buy side imbalance, sell side inefficiency. There's those 2 levels that create the sell side liquidity pool. And right over here is that low exactly at 140, 34, and 4 pipettes. That's that range daily low. Then we have the run up to what level? The level I gave you on Sunday. If it's going to go down and FMC is going to deliver a down move, it's going to go to that fair value gap discount low, hit it, and then drop down to the daily fair value gap. Boom. Pinpoint low, pinpoint high, pinpoint low. Find that in Wyckoff. Find that from Mr. Clishlori. Find that from Steve Morrow. Find it from Gann. It's not there. This is one of those lessons where there's a lot of meat here. It's a lot of meat. And it's not milk, where it's easy to drink, still filling for a little while. This is one of those lessons you have to chew on. And for a new student, it's a lot. Admittedly, it's a lot. But I promise you, there's things that I teach you later on throughout the mentorship and in charter level that helps you frame a lot of the things I'm showing you here. You only need one piece of these types of moves, okay? Notice that I was buying down in here with an expectation that it was going to run up into, but I didn't want to give this to public viewers. But from here to here, that's a one-shot, one-kill. That's 50 to 75 pips. The problem in the wrestling match you're going to have is you want to be able to sell this one to that. And sometimes that's just something going to evade you. And it's okay. It's not a big deal. You can be a seller up here and aim for that plus the spread. Or in my case, 10 to 15 pips, because every broker is going to be slightly off. Some of your live account brokers may not have that matching up exactly. Why is it beneficial to use a demo account? Because a demo account doesn't have the problems that brokerage firms use when they have live accounts. That's why all of their different servers, like if you go with FXCM, I had this problem when I was with them. I had multiple accounts with them, and the lows wouldn't match up. Sometimes they'd be off by 6.5 pips, and the highs would be off, pretty significantly. Why aren't they matching? Because they're going against that pool of liquidity in that specific server. Well, if you look at a demo account, the demo account is closer to interbank price delivery. That's why it's the best tool to learn. Okay? I don't teach this when I combat these yahoos on the internet that say, oh, you're a demo baller, why do you use a demo account? You're learning in the best environment there is, because the demo accounts actually are closer to interbank price feeds than a live account feed will be. Now you're probably thinking, well, wait a minute, I'm going to get screwed if I go into live trading with a live account. That's the reason why I teach you to have this fluff of 5 to 10 pips, allowing for that. And that's why I'm telling you that these yahoos that pretend that they're doing 2 pip stop losses all the time, they might pull it off once in a while, but as a steady diet, they're going to get reamed. They're going to be taken out. They're going to get misquote, and it ain't going to work like that, folks. Okay? It isn't going to work like that. They will not keep you in-house and let you do that. Okay? So the illusion of 2 pip stop losses, while it's possible, I guarantee you, okay, and that's why I said, I put $1 million up there. I said, show me 30 days doing it. Every single trade that's profitable, show me a 2 pip stop loss that did not get tripped. It ain't going to happen, folks. This stuff, they'll run on it. 2 pips is nothing. That's within the scope of reasonable. When you sign up and get a live account opened up, guess what? That's under the definition umbrella of liquidity. Whose liquidity? Theirs. That's why there's different servers when you have these brokerage accounts. Why ain't they in just one server? Why isn't everybody in the same pool of liquidity? Why aren't they piping it out to the interbank price feeds? Because it's in their best interest to have an in-house liquidity pool. Hello. That's the ins and outs of the industry. That's the way it is. But it's also the reason why it's not a bad thing for you to be learning in a demo account. You're learning how these feeds are closely delivered on the interbank level, because they're not going to have tomfoolery inside of a demo account, because there's no incentive to do it. The highs and lows will be closest to the interbank price, because there's nobody in there they're going after. There's no incentive to go a little bit higher or fail to go up as high, so that way they can't get their limit orders tagged. That's the reason why the industry is the way it is. But once you get large enough and you start trading through a prime bank, you will have interbank feeds, and you won't have the problem that these little brokerage account firms that you trade through, like Oanda, even Forex.com, those brokers are insignificant when it comes to trading through a prime. And a prime, you need about like $5 million now to really get it with a prime brokerage account. But you're able to trade in a way where you can have 5 to 7 different price feeds to choose from to do your trading. And you have luxuries that you don't have with a retail account, because you can have sometimes up to 5 minutes to change your mind about receiving that price. Now think about that. When's the last time you could do that with your broker now? Yeah, I don't like that price. Come on now. So they can work with you and give you a different price, because you're out there in the interbank. You're dealing with real deals. You're dealing with real trades, not an in-house brokerage firm matching you up with someone else that wants to take that trade, or they have to take the other side of the trade and provide the liquidity. That is not what you want to do. Can you make money in that environment? Yes, but you want to try to do your best to grow up and out of that and leave retail brokerage firms and work to a level where you can get to about $5 million, $7 million, and then you can start trading through a prime brokerage account. And I will cover those things before we complete all the lessons this year. I know charter members are probably saying, oh yeah, but you got plenty of time before that happens. Right now, just know that the things you're learning, they're for a purpose that is best suited for your development and for your edification. They're not restrictions. They're not limitations that hold you back. They're actually tools that are very valuable for you. And if you remove all these stigmas around, oh, it's just demo, these guys that talk like that, they're never profitable. They're not even profitable traders. They just want to sling mud because they believe somebody they're worshiping is making real money with trades that they never really take because they're spending other people's money. So hopefully this has opened your eyes up to the level of precision that is available with what I'm teaching you here. And it gives you a little bit more detail about things in regards to standard deviations and daily highs and lows. And it builds on that as you go through the mentorship. And I have more lessons. Obviously, I haven't even talked to the charter members that are charter member now that will also amplify things like this. But just know that you are in the right place. And even if I just stopped at this level, you are learning things that's way beyond anybody else out there. Trust me. Okay? There ain't nothing like this on the planet. There ain't no books, no authors, no teachers, no educators, no ex-banker this guy, no ex-banker that girl. None of that stuff exists. You can't find this anywhere. Now you're learning it. Here's what's going to happen. The yahoos in here that are trying to make their bread and butter money, slinging my videos around, they're going to give it to somebody, and then that same person's going to be selling it to their 50, 60 different people for $10 or $15 a month. And then they're doing the same thing, and it starts spreading all over the place. Okay? And then what happens is this Tom, Dick, or Harry goes over to YouTube and says, I'm going to teach you institutional standard deviations. And this is what the banks do. And this is this and that. I'm going to tell you right now, the banks don't do this. This is very, very close to what is implemented to get these levels that I know from an alternative way of doing it. But I can't get in trouble teaching this. And sometimes you're off by 3 pips. That's reasonable in my mind because nothing else delivers that. Nothing else delivers that. So I will see it, obviously, because people see stuff and they say, hey, look at this person over here on YouTube teaching this and stuff. And just know that every single time I see that, another chunk of something else that I was wanting to teach and planning on teaching falls off. So just know that what you're learning here might be making you money selling the videos, but it's also reducing every single time because I'm talking to you that are doing it right now. You know who you are, and you're looking at the money you're making from it, and you're thinking, man, he ain't ever going to catch me. Oh, I know. I know where you're at. You're in a group that starts with 401B. You're in 501C. You're in 201A. You're in 801C. You're in group 101D. You're in 701D. You think you're getting away with it, but I have you all inside of a group now of only 100 people. How long do you think it's going to take me to get you out of 100 people? TikTok.